Banker's acceptance is a financial instrument that is issued by a bank on behalf of its customer. It also in guarantee payment on a future date. It is commonly used in international trade to facilitate transactions. This is how Banker's acceptance works. There are 5 how Banker's acceptance works. First is initiation, which is exporter or seller, and a buyer, which is importer, agree on a transaction, which is the buyer agree to pay at a future date, usually after the goods have been delivered. So first is initiation. A seller or exporter and a buyer or importer agree to a transaction, which is the buyer agree to pay at a future date, usually after goods have been delivered. The second one is bankroll, which is the seller asks their bank to issue a banker acceptance, which essentially means the bank guarantee payment to the exporter, which is the buyer, at the agreed future date. Third is acceptance and payment, which is once the seller or exporter deliver the goods and present the banker's acceptance to the buyer, which is the importer agree to pay the amount specified on the acceptance on the maturity date. So next is marketability. As we know, bankers' acceptance are often traded in secondary market. They are considered relatively safe because they are backed by the bank creditworthiness. The last one is usage. This instrument is especially in international trade where trust between parties might be concerned. It provides assurance to both the seller and the buyer that the transaction will be complete as agreed. By all the explanation, I can say that bankers' acceptance help facilitate trade by providing a mechanism for guarantee payment at a future date, which reduces risk for all the parties involved in the transaction.
Now we move to how banker acceptance works. A banker's acceptance issues deposits upcoming payment with the bank. Time draft, which are deposits that reflect future payments the bank guarantees, are issued by banks in exchange for a little fee. The transfer of liability from the bank issuer becomes the bank obligation upon acceptance by the bank. As a result, the bank's guarantee of payment and the banker's acceptance of the credit rating are often equal. The application process for securities is comparable to that of short-term loans because bankers' acceptance are short-term instruments. In order to make sure the borrower has enough money to cover deposits for future payments, the bank will evaluate the borrower's creditworthiness based on internal standards. Collateral may or may not be required from the borrower depending on the extent of the banker's acceptance. A little portion of the total is charged by the bank to the borrower. This is the illustration of banker acceptance. Firstly, the issuer of the banker acceptance submits a request with the bank, and then move to the second step, which is bank verifies credit information, takes a deposit, and issues a bank acceptance for a small fee. Lastly, the holder of bank acceptance can either receive its face value at maturity or trade it at a discount.
This is market player for bankers. First one, issuing bank. Guarantee the acceptance, add their creditworthiness to the instrument. Second, corporation or exporters. Create the banker acceptance by drawing a time graph. Use banker acceptance to finance international trade transaction. Third, investor. Include institutional investor like money market funds, insurance company, pension funds, and individual investor. Purchase banker acceptance as short-term, low-risk investment vehicle. Next, dealer or brokers. Facilitate the buying and selling of banker acceptance in the secondary market. Provide market liquidity. Fifth, central banks may participate as part of monetary policy operation, influence money supply and interest rate by buying or selling banker acceptance. Lastly, regulatory authorities oversee the issuance and trading of banker acceptance, ensure compliance with financial regulation, and maintaining market integrity.
Here are 5 features of banker acceptance. The first one is short-term financing, which is bank acceptance are used for short-term financing needs, typically with maturities ranging from 30 to 180 days. This can make them suitable for bridging temporary gaps in cash flows. The second one is trade finance instrument, which is they are primarily used in international trade to facilitate secure transaction between buyers and sellers. The importer as buyer initiates the process and the exporter as seller receive the bank acceptance as a guaranteed form of payment. Third is bank guarantee, which is a key feature is the bank guarantee of payment. The bank essentially promises to pay the holder of the banker acceptance at maturity if the importer defaults. This guarantee significantly reduces credit risk for the exporter. Next is discount instrument. Banker acceptance are typically sold at a discount to their face value. The investor return comes from the difference between the purchaser's price and the face value received at maturity. The last one is negotiable instrument. Unlike a traditional check, banker acceptance are transferable. They can be bought and sold in a secondary market before maturity and providing liquidity to investors.
The maturity date of bankers' acceptance is 30 to 180.
There are four benefits if you invest in bank acceptance. For the first one is you can get a high liquidity. Means that an asset can be easily and quickly converted into cash, significantly affecting its market price in the context of bank acceptance. The high liquidity implies the investor can readily buy or sell them in the market usually at price close to the prevailing market value. The second benefit is that if someone invests in banker's acceptance, it has a short-term maturity defining characteristic of banker acceptance. These instruments typically have maturity of less than 1 year and ranging from a few weeks to several months. The short-term maturity of banker acceptance make them an attractive choice for corporations and financial institutions seeking short-term funding. Banker acceptance with short-term maturity are generally less sensitive to interest rate fluctuations. Customers will also get a low-risk investment. Bankers' acceptance are typically issued by reputable banks with strong financial position and history of sound management investing. In bankers' acceptance, issued by these banks reduce the credit risk for investors as these institutions are considered to have a low probability of defaulting on their payment obligations. The last benefit is that banker acceptance offers a regulated market where it can reduce the risk of customers who invest using this instrument. Customers do not worry about the facilities that banker acceptance have provided. This can give customer a good thing and can please customer who invest in banker acceptance.
This is how you guys want to apply bankers' acceptance at commercial bank. So we take example as Maybank. You guys just Google Maybank and then choose application for bankers' acceptance form. And then here we are. So what you guys waiting for? Let's go apply bankers' acceptance at commercial bank now.